The average investor underperforms the market, not because they pick the wrong investments, but because they make the wrong decisions. Whether it's chasing hype, panicking during a crash, or simply doing nothing, these are the silent killers of wealth. In this video, we're going to break down the top 9 wealth-destroying investment mistakes that most people make and how to avoid them so you can build wealth with confidence. Stick around until the end for the bonus tip that wealthy investors never skip. Most people have never even heard of it. Investing isn't just about picking winners. It's about avoiding the traps that derail your financial future. In this video, you'll learn why smart investors rarely make emotional decisions, the hidden costs that are draining your returns, how to protect your money during a downturn, and the mindset shift that separates the rich from the rest. By the end, you'll have a checklist of what not to do and the knowledge to start making more confident investment decisions. Mistake number 1. Timing the market. Everyone wants to buy low and sell high, but in reality, most investors do the opposite. They panic and sell when the market dips, then FOMO buy when it rallies. The data proves it. Missing just the 10 best trading days in a 20-year period can cut your returns in half. No one, not even professionals, can time the market consistently. Instead, focus on time in the market. Long-term investors build wealth through consistency, not prediction. Think like Warren Buffett. Our favorite holding period is forever. Mistake number 2. Chasing the hype or hot picks. Heard someone say a stock is going to the moon? That's your cue to walk away. Chasing hype is like trying to win the lottery. It feels exciting, but it's rarely profitable. Whether it was .com stocks in 2000, crypto in 2021, or meme stocks in 2023, the story ends the same: a crash and burned portfolios. Wealth isn't built with gambles. It's built with a disciplined strategy. Smart investors focus on assets with solid fundamentals, real-world value, and long-term potential. Mistake number 3. Ignoring fees and taxes. A 1% fee doesn't sound like much until you realize that over 30 years, it can eat up hundreds of thousands in compound growth. And if you're constantly buying and selling in taxable accounts, you're paying Uncle Sam before your money has a chance to grow. Solution? Use low-cost index funds, ETFs, and tax-advantaged accounts like Roth IRA 401, HSA, IULs, and other tax-efficient strategies. Wealthy people don't just grow money, they keep more of it. Mistake number 4. Investing without a clear goal or plan. What are you investing for? Retirement? A home? Legacy wealth? If you can't answer that, you're just throwing money into the market and hoping for the best. You need a written investment strategy that defines time horizon risk tolerance, asset allocation income needs tax approach. Your goals should determine your investments, not the other way around. Mistake number 5. Letting emotions control your portfolio. Fear and greed are the most expensive emotions an investor can have. Fear causes you to sell low. Greed makes you buy at the top. The best investors like Ray Dalio and Charlie Munger remove emotion from the equation entirely. How? Automate your contributions. Stick to a schedule. Avoid checking your portfolio during volatility. Talk to a financial advisor before making drastic changes. Investing is emotional, but your decisions don't have to be. Mistake number 6. Lack of diversification. Ever heard someone say, "I only invest in real estate," or "I'm all in on crypto"? That's not confidence. It's overexposure. Diversification isn't about playing it safe. It's about being smart. By spreading your investments across multiple asset classes, sectors, and strategies, you reduce risk and smooth out returns. Here are some examples: stocks, bonds, and real estate, U.S. and international markets, growth and income strategies, and tax-free and taxable accounts. Mistake number 7. Starting too late. I'll start investing when I have more money. That sentence has cost people millions. Time is your biggest advantage. Even small amounts invested early can grow into huge sums. Example, $200 per month at 10% for 30 years equals over $450,000. Wait just 10 years, and you cut that down to $170,000. Don't wait for the perfect time. Start where you are with what you have. Mistake number 8, not rebalancing your portfolio. Let's say you start with 70% stocks and 30% bonds. If the stock market rallies, suddenly you're 85% stocks without even realizing it. That means your risk exposure is higher than you intended. Rebalancing once or twice a year brings your portfolio back to your planned mix, keeping your risk and reward in check. Bonus. It often forces you to sell high and buy low, the exact opposite of what most people do. Mistake number 9, not protecting your wealth. What happens if you pass away unexpectedly, get sued, or face a market crash right before retirement? Smart investors protect their wealth with life insurance asset protection strategies, emergency funds, estate plans, and trusts, private wealth vehicles like indexed universal life or annuities. Building wealth is half the equation. Keeping it protected is the other half. Bonus tip, what the wealthy always do. The ultra-wealthy don't just invest, they engineer their wealth. They use tools that average investors overlook. Infinite banking with IULs leveraging assets for passive income. Investing through entities for tax benefits. Creating multi-generational wealth strategies. You don't need to be a millionaire to start thinking like one. It's about mindset, strategy, and execution. Which of these mistakes have you made or avoided? Drop a comment below and let's talk. If you found this helpful, like the video, subscribe, and share it with someone who needs to protect their future. And if you're serious about growing wealth, check out our next video. How to build wealth from scratch even on a small income. You're watching Smart Wealth Planning, where financial clarity begins.